For the past 40 years, investors have been rewarded for owning the same assets: tech stocks, index funds, real estate, and bonds. With these investments, we just went through one of the greatest wealth-building periods in modern history. And recency bias makes people believe it will continue. But the last time the United States experienced stagflation, the winners looked completely different. Imagine investing $100 in 1973, right before stagflation hit the economy. 7 years later, some assets had multiplied in value. Others barely moved. And some had quietly lost almost half their purchasing power after inflation. In this video, we look at different investments and find out what won and what lost during stagflation. Now here's the uncomfortable question. If stagflation returned today, knowing that most people are heavily exposed to stock market index funds, would most portfolios be positioned to win or to lose? Let's find out. Before we look at what happened to different investments, we first need to quickly understand what stagflation actually means. Normally, the economy and inflation move in the same direction. When the economy is strong, inflation tends to rise. When the economy weakens, inflation usually falls. But stagflation breaks that relationship. Stagflation occurs when three things happen at the same time: slow economic growth, high inflation, and rising unemployment. That combination is extremely difficult for policymakers to manage. Because the tools used to fight inflation, raising interest rates and reducing money supply, often slow the economy, while the tools used to stimulate growth, cutting interest rates and increasing money supply, can make inflation worse. The United States experienced its most famous stagflation period during the 1970s. Inflation rose dramatically throughout that decade. In 1980, inflation peaked at nearly 15%. To understand how unusual that was, the average inflation rate in the United States over the past 2 decades has been closer to 2 to 3%. So the 70s represented a completely different economic environment. And that environment reshaped how different investments performed. Now this is where things get interesting. Let's run our experiment. Imagine investing $100 in 1973, right before the stagflation period started. Let's see what happened to your $100 depending on what you invested in. Gold saw one of the most dramatic moves. Had you invested in gold in 1973, by 1980, your $100 would have turned into $1,300. That's a gain of more than 1,200%. Oil prices exploded as well. Your $100 investment would have turned into $1,200. That's an increase of more than 1,100% in 7 years. Broad commodity markets did very well during this period. Energy producers, mining companies, and resource businesses experienced enormous gains, bringing you to about $400. That's a plus of 300%. Real estate saw a lower performance. The median U.S. home price rose from roughly $32,000 in 1973 to about $64,000 by 1980. That's a gain of around 100%, bringing your $100 to $200. But the story looked very different for portfolios that most people have today. Bonds, often a large part in people's retirement plans today. $180. And stocks, measured by the S&P 500, performed even worse during stagflation, bringing your invested $100 to only $150. And it's important to note, not all stocks behave the same. Companies whose valuations depended on future growth which would be equivalent to today's tech stocks, were hit even harder. Why is that? Because when interest rates rise, the value of expected future profits falls the most. We'll explain this in more detail in a minute. Now, looking at this overview, we would do you a disservice if we left it here. We're not going to do that, because what actually matters during stagflation are real returns, not nominal returns. Since inflation was so high, we have to adjust for that. What matters is how the real purchasing power of your $100 changed. And to make it even easier, we'll show those as averages per year. Let's do that. Cumulative inflation from 1973 to 1980 was 110%. Yes, the CPI roughly doubled over that period. So after adjusting for that, we have gold, an average of plus 82% per year after inflation. Oil, plus 75%. Commodities, plus 14%. Real estate, plus 4%. Bonds, minus 5%. And stocks, minus 6%. Per year. This means stocks would have lost you more than 40% of your portfolio's real purchasing power over the 7-year stagflation period. Now, what does this actually mean? It means stagflation didn't just affect the economy. It completely reshuffled the winners and losers across every major asset class. To understand why these outcomes were so different, and if it could happen again, we need to look at how financial assets are priced. Many investments, especially growth companies, derive most of their value from profits expected far in the future. Today's tech companies are a good example for this. Investors buy them because they expect earnings to grow for years, or even decades. When interest rates are low, those future profits are worth a lot today. But when inflation rises, interest rates usually rise with it. And that dramatically reduces the present value of future profits. In the industry, we calculate what's called the present value of future cash flows using the discounted cash flow model. Look it up, it's fun. In other words, assets whose value depends on the future suddenly become less attractive. Meanwhile, assets tied to physical scarcity behave very differently. For example, oil producers sell energy today. Commodity producers sell resources today. And gold often benefits when investors search for stores of value during periods of monetary instability. So stagflation doesn't just change the economy. It changes which assets the entire financial system rewards. Now it's worth asking another important question. Why did stagflation happen in the first place? Several things happened at the same time in the 70s. One of the most important was the 1973 oil embargo. Major oil-producing countries restricted exports to the United States. Oil prices went through the roof. Energy costs across the entire economy skyrocketed. This hit everyone: consumers, companies, and the government. At the same time, the US economy was already dealing with rising inflation after years of more and more government spending and monetary expansion. These two things together created a powerful inflation shock. And inflation that high is extremely difficult to control. By the end of the decade, the Federal Reserve was forced to raise interest rates dramatically against all opposition. At one point in 1981, short-term interest rates rose above 19%. 19. Yes, those rate hikes eventually lowered inflation, but they also triggered a severe recession that lasted for years. Now let's compare that environment to today. Most modern portfolios are built around assets that performed extremely well over the past 40 years. Technology companies dominate stock markets. Index funds concentrate heavily in large growth companies. Most popular S&P 500 index funds today, VOO, SPY, IVV, and others, have a magnificent 7 exposure between 30 and 36%. For NASDAQ-heavy index funds like QQQ, it's between 40 and 50%. So a lot of investors today are highly exposed to tech stocks. Now, this can be a great thing in non-stagflationary environments. But during stagflation, things were very different. Also, today, bonds are considered a cornerstone of diversified portfolios. They're very popular in many 401k plans. You may hold bonds in your 401k without even specifically knowing. And in today's market, many investors also hold crypto assets. These didn't exist in the 1970s. And economically, the jury is still out on crypto. Crypto may behave like high-growth, long-duration assets, which would mean very poor performance during stagflation, similar to growth stocks. Or it may behave more like commodities or real assets, which would mean that crypto performance would be on the high side. The most common investment strategies we see today, often highly simplified into just dollar cost average into an index fund, were built during one of the most stable inflation environments in modern history. From the early 1980s until around 2020, inflation steadily declined. Interest rates followed the same downward trend. And that environment strongly favored assets tied to future growth. Now, this doesn't mean those investments are bad, but it does mean their performance has been shaped by a very specific economic environment. So the real question isn't whether stagflation will definitely return. The real question is this: what happens if the economic environment that shaped modern portfolios changes? Because history shows that different environments reward very different assets. In the 1970s, gold surged, oil prices exploded, and commodities and energy dominated. Meanwhile, bonds stagnated and stocks struggled. Understanding those dynamics doesn't mean predicting the future, but it does highlight something investors often overlook. Investment success depends not just on choosing good assets, but on understanding the economic environment those assets operate in. If you want more structured macro breakdowns like this, consider subscribing.